Well, good morning and welcome to the Reserve Bank. Very pleased to have with us students from Taupo Nui Atua College, who were the winners of the Reserve Bank's Monetary Policy Challenge, which is conducted amongst about 70 high schools in New Zealand. So welcome, it's good to have you here. With me I've got John McDermott, who's the bank's chief economist, and Jason Wong, who's the head of financial markets research. The economy is expected to grow by around 3.75% this year. Economic growth continues to be supported by increasing construction activity and ongoing strength in consumption and business investment. A high level of net immigration is also adding to overall demand and productive capacity. Economic growth is projected to moderate to around 2.75% next year due to the recent decline in commodity prices and the impact of policy tightening. The high exchange rate continues to restrain growth in the traded sector. The exchange rate is yet to adjust materially to the lower commodity prices. We believe its current level remains unjustified and unsustainable, and we expect a significant depreciation. The economy appears to be adjusting to the policy measures taken by the bank over the past year. But there remain risks around how the rise in net immigration will affect house prices and how much inflation pressure will increase as capacity constraints are met, especially in the construction sector. In light of these uncertainties, and to better assess the impacts of policy tightening and the decline in commodity prices, it's prudent to undertake a period of monitoring and assessment before considering further policy adjustment. Nevertheless, we expect some further policy tightening will be necessary to keep future average inflation near the 2% target midpoint and ensure that the economic expansion can be sustained. So thanks very much. We're happy to take questions.
Just wondering whether this had anything to do with the proximity of the election leaving the OCR where it is now.
No, not at all. We've got a mandate in respect of an inflation objective. We've had 4 tightenings so far since March, and we felt that at this point the economy is responding well to the tightening, and it's time, as we signalled in July, to take an assessment and to reflect before there's any further policy adjustment.
What are the risks that we get a lower GDP number than you're forecasting next week?
In terms of next week, John, did you want to?
I mean, the risk's always there with any forecast. But we've just seen the manufacturing numbers come out, perhaps a little bit lower, but construction numbers are looking more positive. So I'm as confident as you can ever be with the forecast that we have.
Governor, you mentioned net immigration 3 times in the 5 paragraphs of your policy assessment. Does that reflect how large it's looming in your calculations at the moment?
It's a significant factor. I mean, the net immigration's been stronger than what we were forecasting, and I think pretty well every other forecaster around town has been surprised by the strength of it. So it's currently running at around 41,000 on an annual basis. And if you go back to 2012, I mean, it was running 0 or close to 0 on an annual basis around that time. So we've spent quite a lot of time looking at the flows to see to what extent it reflects fewer people leaving the country, more people arriving. Those people arriving, what do we know about them? What's their age composition? Are they here on temporary work permits? And we also think about the impact on the housing market, because this really is quite a significant net immigration inflow.
Governor, you've called the currency unjustified. It's come off its highs in July. Has the central bank been intervening in foreign exchange markets?
We do think the exchange rate is unjustified and unsustainable. As to intervention, I'd prefer not to comment. Thanks.
Sticking with the exchange rate there, you've got, although you're sort of talking about it being unjustified, expecting a significant depreciation, the TWI track, you've got it coming down a little bit, but doesn't look like it's you're forecasting any huge drops there. Is this a sort of case of, I don't know, a bet both ways, or are you sort of just basically not too sure what's happening there?
It's a good question. I mean, when you do forecasting, you have to make an assumption around the exchange rate. So, for example, the OECD, when they do their forecast, they forecast a fixed real exchange rate for the countries that they're doing the forecast. For the IMF, they forecast a fixed nominal exchange rate. What we tend to do is we tend to say, well, look, if you've got an exchange rate overvalued, then over time you'll get mean reversion. The exchange rate will come back towards an equilibrium value. And so there's a technical assumption just about how quick that might be. There's, I think, an opportunity here in a sense, and that the market is assessing that the next policy tightening will be around April next year. If you look at the OIS pricing, it builds it in around April or so. If that is correct, if that turns out to be correct, then really the Bank of England and the Federal Reserve are likely to be increasingly focusing on their interest rate adjustments and policy tightenings around that time, and that debate, I think, will be even louder than it is now. So that will come into the equation as well.
Governor, is there a minimum time of a pause in seeing what happens with the economy?
No, I don't think so. I mean, we'll look at a number of issues. I mean, we'll look at the extent to which house price inflation is affected by immigration. We'll look and see what happens to inflation as capacity starts to tighten. We're seeing inflation in the construction sector in Auckland and Christchurch running at around 6% at this point. So we'll watch to the extent to which that spills over into general price inflation. And we'll also look and see what happens to the exchange rate. So we'll be monitoring a lot of things. So, but as I said, the market is anticipating that the next tightening will be around April next year.
What was the thinking behind lowering the track for the forecast 90-day bank bill?
Did you want to take that, Jason?
Well,
it's more of an economic question.
I'll pick on that. I mean, when you're looking at the interest rate track, you're looking at all the features of the economy. So we've been watching the key drivers, what's been pushing this economy forward. There's been a very strong trend in terms of trade. We've touched near 40-year highs. We're probably watching that come off a little bit in recent times, particularly if you're looking at the dairy prices and so on. Again, watching a big driver of the economy being the rebuild in Canterbury. It's probably nearing its peak in terms of the growth potential that it's got in there, although a lot of strong activity. And so as you get into that peak in a growth cycle, although the economy was still expanding, it's probably going to be expanding at a slower rate. And that was the key sort of economic feature behind the lower track.
Also, if you look at the inflation pressures in the economy, I think you could say that the inflation pressure is a little less than than what we had anticipated, and I think that's true for many forecasters. I mean, you see tradables inflation is still around zero, given the high exchange rate. But you've seen longer-term surveys of inflation expectations fall a bit in the last month or two, and you've seen quite a lot of moderation in terms of wage inflation. So they were also factors that were part of it.
Could you talk through why the net immigration increase perhaps is not delivering the house price inflation or the demand impetus that maybe yourselves and others might have thought a few months ago?
Maybe I'll make a few comments and maybe John can add to it. I mean, you know, we were puzzled by that as well. And so we looked at, you know, what's the split in terms of the net? What are the two flows that are there? And early on, that net figure was driven by fewer people leaving the country rather than more people coming in. That tends to have changed more recently. If you look at the composition of people coming in, they tend to be, compared to, say, earlier immigration cycles, they tend to be a higher proportion of younger people, people without families, people here on temporary work permits, linked to Canterbury construction, for example. And so we think that relationship between migration inflows and the demand for housing is probably a little bit different this time than previous cycles. But John, did you want to add anything?
Yeah, I mean, the composition issue is very important, and we've been working hard to try and understand some of those features. In addition, we've also been increasing interest rates, and there's the loan-to-value ratios that people are sort of having to reflect on and worry about the future and how much debt they're really willing to take on. And that's probably somewhat different to previous cycles. So we're seeing a much more prudent household sector, particularly around the housing market.
I had a look through the monetary policy statement for some comments on the fiscal track. Previous statements have talked about the fiscal situation dragging a bit on growth. What's your view at the moment on whether the fiscal track in the budget and the PREFU also acts to help you slow the economy a bit?
Well, we think as you move towards surplus, that the impact will be to act as a drag on growth. We don't believe in crowding in effects that basically say that as you contract the fiscal deficit, it's in fact expansionary. We don't believe that. We think the Keynesian effects tend to dominate in any fiscal adjustment. And by and large, we leave the actual mechanics of forecasting the fiscal position in terms of, the composition of government spending, the design of tax revenue, and all of that. We leave a lot of those numbers to the Treasury. Did you want to add anything, John?
I think that covers most of it. I mean, you're probably right. We haven't highlighted it at this time, but it's still the feature of fiscal policy moving back to balance is one of the forces that we've been conscious of for a long time, and is probably restraining the growth profile. So you can think about, I've talked previously about the accelerators, being the terms of trade and the rebuilding Canterbury, the brakes probably being the exchange rate and fiscal policy, and that really hasn't changed.
Loosening of fiscal policy in the budget, and some would argue with the various election promises there might also have been another loosening. Is government being enough of a mate for monetary policy here?
Again, I was talking about the broad features, so we still have a budget position moving towards balance, and that's what really matters for monetary policy. And there's some marginal changes, but not sufficient to change our view of the world or the economy.
Governor, you're projecting housing prices to keep cooling in the next 2 to 3 years, down almost to zero. Does that suggest that we're going to see quite significant falls in prices in some areas?
I think in any national market, you'll always find relative adjustments that some house prices go up rapidly and some may in fact fall. There'll always be that regional supply and demand balance that's tied in with demographics and the demand for housing and to what extent new supply is being built. We are expecting house prices to continue to moderate. The LVRs, I think, have by and large had quite a significant effect in terms of reducing the volume of housing sales, which is still down, I think, around 12% compared to a year ago. And we've seen quite a lot of moderation in national house prices. They were running roughly at around 10%. They're running at roughly 6.25% now. Auckland's down from 17 to about just over 9. And the RINES data that we'll look at closely will be out, I think, by Friday, and that may show, that'll give us a further insight as well. So the combination, I think, of the LVRs plus the interest rate tightening has led to, on a national basis, quite a lot of moderation in house prices. The uncertainty for us, or the biggest uncertainty for us, is really around the, dare I say it, the net migration.
Your 90-day bank bill rate forecasts are higher by December. It looks like could be around 1/4 basis point. Does that mean that we could have a rate increase this year still? And also, ahead of the election, there's always a possibility of a change in government, and one of the things that opposition parties have talked about is expanding the RBNZ's mandate in terms of monetary policy. Are you concerned about that at all?
I'd prefer to leave the latter question about what may or may not happen. On the 90-day track, I mean, I wouldn't read anything significant into that 1/4 basis point.
The current 90-day rate is 3.77, and in our statement we got 3.80 for December, so there's nothing in it really.
It's not intended to show a policy adjustment. We always have the challenge of just in showing a forward track, just working out the just what would be a smooth adjustment over time, and so it's partly the lumpiness of that.
One of the risks mentioned in the monetary policy statement is that fixed mortgage rates remain low even though the OCR and floating rates rise. Could you talk about that risk and whether we face another repeat of some of the problems seen in 2004 to 2007?
Yeah, I mean, I think that's a good question. It's almost inevitable that you're going to get a flattening in the yield curve in a situation where you're tightening monetary policy and the rest of the world, at least most of the advanced economies, in fact all of the advanced economies are not tightening monetary policy, and they have interest rates very close to zero. So it's almost inevitable as you tighten and banks continue to finance offshore that the yield curve will start to flatten. If you look at the mortgage market here, the interest rate duration of the mortgage market is incredibly low. I mean, in the States, I mean, you have 30-year fixed mortgages, the sort of standard mortgage, where the interest rate duration is very long. Here it's extremely low. So you've got 30%, for example, of the mortgages, basically floating rate mortgages. You've got another 32% that are fixed for less than a year. So you are going to see monetary policy working in terms of the average time to when you get a rate reset, which I think at this moment is around 10.5 months or so.
The Federal Reserve seems to be focused more on wage inflation now than actual inflation. What's your view on whether the Reserve Bank here should be focused more on wage inflation than it is?
Well, it's something that we look at very closely. I mean, if you're going to see inflation pressures really start to rise intensely, then it'll tend to come through either tradables inflation, which is linked to the exchange rate and overseas export prices, or in other words, our import prices, or it's going to be in unit labour costs. So we look very carefully at what's happening in the labour market, what's happening to participation, what's happening to employment, what's happening to the composition of full-time versus part-time employment. So it's something that we look at very carefully.
Governor, there seemed to be quite a turnaround in the projections for the household savings rates. I'm just trying to get my head around, is that largely from reduced demand for new mortgages from a cooler housing market, or are you actually seeing real behaviour in positive savings?
It's probably more the latter. If you think about the last business cycle, savings rate went extremely negative. People built up a lot of debt through that process. And the world's largely changed. People are not willing to be, I think, as reckless as they were perhaps in the past. Certainly there's a more desire to be prudent. And while the overall debt stocks are probably not being reduced very rapidly, if at all, we're not in a period where we're adding to them. And so we're seeing those savings rate now move to sort of zero or mildly positive through the forecast horizon.
In the monetary policy statement, there's a discussion about the increased issuance of cowries and euro kiwis in the last year, doubling to 1.3 billion. What are the risks that, as the European Central Bank gets involved in quantitative easing and tries to deal with its apparent deflationary problem, that we see another increase in these euro kiwis, which puts more pressure on the New Zealand dollar?
It's possible. We haven't seen the Uridashi flow out of Japan that we saw, for example, in the 2005 through 2007 period, for example. But we may well be in a situation where the Bank of Japan has a further round of quantitative easing. You're right that the ECB is looking at LTROs, I think they're called, and have a large program of lending there, plus also potentially being in the market for asset-backed securities, purchasing those. The issue is whether they then go further to start buying back government securities, where there's quite a lot of controversy, as you know, in the ECB board around all of that. But it is possible that once you get into that world of further accommodation, that you will see more issuance of cowries or euro kiwis and things like that. But at the same time, we're also going into a world where interest rates are likely to be rising in the Bank of England and Federal Reserve in terms of their tightening. So that'll change the dynamics as well. But Jason, did you want to add anything?
Yeah, I can't really add too much from that. I mean, we saw this as a bit of a risk, say, a year ago when the Japanese started their massive QQE policy. And from that point on, we monitored Japanese flows pretty closely, and we've seen those pick up a little bit, but absolutely nothing on the scale compared to 10 years ago. So, yeah, in this low interest rate global environment, that's always a risk, and what I can say is we are monitoring it. But at this stage, it hasn't been really a big impact.
I think Brian wanted the floor.
I just wonder about geopolitical risks, increased instability in the Middle East, Ukraine, Ebola out of control in East Africa, an increasingly disunited kingdom. Do factors like that weigh on an interest rate decision, or do you just have to be fatalistic and await events there?
You certainly have to be very conscious of them. I mean, you've seen, for example, what's been happening in Europe in terms of, say, their 10-year bond rates, where I think 10-year Spanish rates and 10-year French bond rates were recently at 250-year lows, for example. And then you've seen the potential impact of the Russia-Ukraine tension and what that has further done to spreads. You've seen it reduce the euro. The euro's come off quite significantly in the last 2 or 3 weeks as the dollar has started to strengthen as well. You look at the Middle East situation very much for what might be happening in terms of spillovers of that impact, how it might affect demand for oil, and how that might flow through to us. The Ebola thing is, I mean, it's very interesting what's happening at the moment in East Africa, and also extremely worrying. But I don't think financial markets would be as concerned about that as they would about the former two.
The government has announced plans to double first-home buyer subsidies for new homes. Are you concerned that this works against the Reserve Bank's moves on with the high LVR speed limit to try and slow down the housing market?
Yeah, I'm not going to, forgive me, I'm not going to comment on policy that's so close to an election.
Just a final point on migration. What gives you the confidence that other economies and their job markets are going to improve so much that high flow will fade away pretty quickly? Is this going to be a rapid turnaround in Australia's economy, for example?
We're not forecasting, forgive me, a rapid turnaround in migration. We think that the migration issue will be with us for quite a period of time. There is a link in terms of trans-Tasman flows with the Australian labour market. And, the Australian economy has some challenges in terms of adjustment at the moment, in terms of it's adjusting to lower capital expenditure on mineral projects, which traditionally have been around 2 or 3% of GDP. It peaked at around 8% of GDP a couple of years ago, so they're going through that transition. They're also having to adjust to a terms of trade decline, particularly around iron ore prices, which I think now are about 45% below peak. And they're also having to adjust to a fiscal correction that lies ahead of them. So it's possible that that at least in terms of trans-Tasman flows, these could continue for a while.
Governor, I just wondered about the dollar. You're talking about it remaining unjustified and unsustainable, but I'm wondering what you think about the fact that you're signalling interest rates will continue to rise in the future, that you are going to continue to underpin it being unjustly high and unsustainable.
We think that, as you say, unjustifiable and unsustainable. I mean, if you look at the last 3 major exchange rate cycles, say since 1985 or so, there's been 3 big exchange rate cycles. One, there's been quite a close correlation between the terms of trade and the exchange rate. And we're not seeing that in terms of this adjustment here. And secondly, when the exchange rate has come off, it's tended to come off really quite rapidly in each of those cycles. So we think that there is the potential for a significant exchange rate fall here. In terms of policy tightening, in essence, we have a mandate that requires us to try and achieve inflation of the order of 2% in the medium term. And it's something that we look at very carefully when we're making those policy changes around inflation. We look very closely at what's also happening to real growth in the economy and also what's happening to the exchange rate as well. So we feel that the inflation pressures are still likely to come through. The economy is growing, as I say, around 3.75%. Potential output's probably around 2.8 or thereabouts, we think, will probably slow down in terms of growth to around potential output next year. But it still means that there are risks on the upside around inflation tied in with capacity constraints and also the construction sector. So we'll look at that pretty carefully. And we think that some further policy tightening will be needed. If you look at interest rates now, I mean, we've tightened 4 times, but they're still below neutral. I mean, we think the neutral interest rate's probably around 4.5%. So we're essentially about 100 basis points below neutral. So in that sense, we're still acting in a stimulatory way in terms of impetus to growth, even though we have tightened 4 times.
You mentioned in the monetary policy statement that there's evidence productive capacity is growing, perhaps in part because of the migration, and there's some business investment. Could therefore there be a reduction in that neutral level for the official cash rate if you see some increase in that productive capacity?
Yeah, I think that's right. I mean, we think productive potential has picked up from somewhere around about 2.5% to around 2.75% to 3%. And, you know, a corollary of that would be that the economy can grow faster in terms of trend rates of growth without the same inflationary pressure. And that would have the impact of lowering the neutral rate of interest. So I agree with that, yeah.
So the neutral rate's around about 4.5% now. Mm-hmm. How much potential is there for it to drop further?
Well, I'll get John's thoughts on that, but it would largely depend on how quickly potential output starts to rise. And in general, that's a fairly slow process because you're talking about the vintage of the capital stock, the quality of the capital stock, how quickly that starts to change through new investment flows. Will the historic level of participation that we currently have, will that be sustained? What might happen to migration? And then there's all the structural policies that affect the trend rate of growth as well. But John, did you want to add anything?
That's exactly where I would have gone. You know, and we're talking about 2 concepts that economists invent, and they're invisible, and so there's no data you can go back and verify. What you have to do is monitor the economy over a period of time, and you slowly learn how these things develop and form a judgment and using with the various frameworks. So, well, there's potential. We'd never be in a rush to move these concepts around because they change your interest rate forecasts in quite arbitrary manners. So it'd be one where we'd be evolving forecast by forecast round. You know, we may come back in a year and say, this is what we've learned, this is the feedback, and this is how we've changed it.
It's all right, you've just answered my question.
Well, thanks very much indeed. Thank you.